can we expect some kind of positivity given the really dire year that we've had for markets?
Good morning, Tom. Well, if you take the Chinese reopening, that would probably be a catalyst for a mini Santa Claus rally that indeed starts typically on a day today and then lasts a few days. Because that Chinese reopening story, I think, is the big macro story for next year. As you highlighted in the segment before, the stock market down being between 8 and 30%, and the yield curve inverted and oil prices up. And, it just all points into this recession scenario next year. And I think this Chinese reopening is something of a counterweight to that scenario, because if it does fully reopen, not just for tourism, but just for economic activity, then all the disruptions that you've seen in factories and in trade and so forth is all going to be somewhat limited. And I think that will be positive for markets. So you could, for that reason, see a little bit of a rally in the next few days. Just try to digest that scenario of a, say, fully reopened Chinese economy.
Should that be something that we should extrapolate into a medium to longer term trend? You mentioned, I mean, that's a big macro factor, the world's second biggest economy, some of the reopening optimism there. But is it enough, alongside headlines here in the U.S., to have more of a rally in the first half of this year? Or are we destined for something more of a choppy trading range and perhaps even more downside to come?
Yeah, we're more on the side of the choppy trading range because the China reopening is a big factor. It would drive commodity demand, it would drive trade, it would drive, I guess, investment too. But we know that this is not going to be the way it has happened in the United States or in Europe, where you had a sudden surge of activity. I think in China it will be in stages that happens. Secondly, we do deal still with inflation. Now it's moderating, but I think to many others that have pointed out to this, if China does reopen, that commodity demand will push up inflation somewhat again. And you can tell from the crude markets having recovered now from the lows of around $70 and to $80 or so, that's an indication of that headline CPI may not moderate as much so fast as some people think. And that keeps, I think, our stock market in a bind because, as we all know, that will lead the Federal Reserve to continue to maintain this very hawkish language, potentially hiking maybe more than what people currently discount. So we're in the choppy trading range scenario for the first half.
Now, Ben, those are the big macro, big picture factors that are affecting markets right now. We're also on the cusp of another earnings season, one that's going to be highly scrutinized because we want to see whether or not those Fed interest rate hikes have slowed down the economy, have hurt perhaps corporate earnings. Do you think that corporate earnings story remains intact as we head into this coming earnings season?
I think there's a significant difference between sectors, Dom. Industrials have done quite well. And I think that probably has to do with that there's still, a fair bit of activity going on in the economy that these companies can outperform as a result, basically anticipating better earnings. But then you go to the retail side or financials or even other cyclical sectors, they're all weakening, including tech, right? And I think earnings, as people are very worried about it, is going to be that component of the recession that will present itself in the first half, and why you have this difficult market that we had over the last few weeks. One thing with earnings and margins in particular is that even though inflation has come up a lot, and as you said in the other segment, consumers continue to be willing to spend despite high inflation. In the end, the irony can be as inflation starts to roll off really fast, that can affect margins very negatively. So I think this earnings season coming up in the first quarter will be challenged by the fact that, the pricing power is eroding. And as a result, it puts pressure on earnings.
All right. So, Ben, you're a portfolio manager. You're an investment strategist. Your job is to position these client accounts and funds in the way that you see the best appropriate for, the coming months and perhaps even quarters in the future. What exactly does that positioning look like? Are you heavier in cash right now, more into bonds with yields where they are? Are equities still attractive? And what's the mix?
Yeah, the mix is on the one hand still defensive on the equity side. We like materials, we like energy, we like healthcare. These are themes that have played this entire year. And we still think that hasn't played out entirely yet. There's, I think, a lot of upside still, given this Chinese reopening, given that the recession scenario is not immediately imminent. It's not an economic recession, maybe more earnings recession. And energy, healthcare, and material sectors are actually better positioned for this earnings recession. They have high cash flow companies. On the other hand, as you mentioned, bonds have become more interesting. Now, there are differences in bonds. I'd say that these treasury yields you show, we like more the front end of the yield curve, where ultimately, as the Federal Reserve tightening cycle is completely discounted, there's where your return will be in the future. At 4.34% is much more attractive than 3.75 in the 10-year. Lastly, you don't want to be completely in cash, but you got to be mindful of that. We do deal with geopolitical tensions. We do deal with potentially another energy shock, perhaps from this Chinese reopening. Just general uncertainty about if the economy will fall into a recession, yes or no. And that will lead you to at least keeping your cash somewhat on the sideline. But granted, you can invest it at a very short end of the yield curve at attractive rates.